Welcome to the Deep Dive, where we cut through the noise to get to the true story behind the headlines. Today, we're plunging into Starz Entertainment's Q2 2025 results. And trust me, there's a fascinating, pretty complex narrative unfolding here that goes, well, way beyond the initial shockwaves you might have seen on the stock market. You probably saw some of those top-line numbers, but we're going to unpack what it all really means for the company's strategy, their path forward.
Indeed. Yeah, while the immediate headlines might have given investors, let's say, significant pause, there's a much more nuanced story emerging. It's really about Starz's laser focus on cost discipline and a unique, maybe somewhat unconventional content strategy. We'll look beyond those immediate figures, try to understand the long-term vision management is trying to sell, and critically, how plausible is it?
All right, let's get right to the numbers then. The ones that certainly grabbed everyone's attention and not really in a good way. Starz Entertainment reported a net loss per share of $2.54. That was a significant miss compared to what analysts were expecting. A pretty stark indicator, right?
Oh, absolutely stark, yeah. And adjusted OIBDA, it saw a sharp sequential decline, plummeting, really, to $33.4 million. That's way down from $92 million in the prior quarter.
Wow, $33.4 million from $92 million. That's a massive drop. Immediately raises questions.
It absolutely does. And the revenue picture wasn't much better, coming in at $319.7 million. This also missed consensus estimates, showed declines both sequentially and year over year. It wasn't pretty.
Okay, so revenue miss, OIBDA drop. What about subscribers? That's always key.
Right, and that's maybe where the immediate investor disappointment really, crystallized. U.S. OTT subscribers dipped by 120,000, bringing them down to 12.2 million. And total North American subscribers were down by an even more significant 520,000, landing at 19.1 million. These figures, you put them all together, they signaled a clear sentiment of investor disappointment. The stock definitely reflected that after the call.
Okay, so those are the headlines, and they're undeniably tough. Let's dig into the why, though. What was the primary culprit for that really sharp sequential drop in adjusted OIBDA?
Yeah, the primary driver for that drop was higher content amortization. This wasn't necessarily completely unexpected, but it hit harder because of the timing of some major series releases. Specifically, we're talking about airing 6 episodes of Raising Kanan Season 4 and the premiere of BMF Season 4.
Oh, okay. Big shows.
Exactly. These are big, pretty expensive shows for Starz. And when they hit the amortization schedule, especially in a quarter where, subscriber growth wasn't really offsetting those costs, it had a direct and pretty significant impact on profitability.
And speaking of BMF Season 4, management mentioned that while it definitely drew a large audience, it just didn't maintain the expected scale in attracting new subscribers. What does that specifically tell us? Maybe about their core demographic, or perhaps the effectiveness of their strategy to expand rather than just retain? Because that softness in gross ads seems critical.
That's a really critical distinction to make, yeah. And it underscores a challenge, frankly, for a lot of streaming services right now. It suggests that while their existing base is highly engaged with these big shows, they'll definitely tune in for BMF, attracting truly new. Incremental subscribers for these expensive properties is just getting harder and more costly. For Starz, with its very specific demographic focus, it highlights that while the content resonates deeply within its niche, it might not have that broad crossover appeal needed to drive significant new subs on its own. So this kind of reinforces their strategic pivot, right, towards cost efficiency and leveraging existing franchises for retention rather than betting the farm solely on big new shows for mass acquisition.
That's a fascinating point, that expansion versus retention dynamic. So, okay, content performance had challenges, but let's look at where the company is maybe showing some resilience. Despite those subscriber headwinds and the profitability dip, the exec team seems laser focused on another area, shoring up financial health. How are they tackling the balance sheet?
Absolutely. Despite these quarterly setbacks, Starz is definitely placing a very high priority on its financial health, balance sheet management. We saw tangible progress here. Net debt was reduced by $42.1 million sequentially, ending the quarter at $573.5 million. This brought their leverage down to 3.2x net debt to adjusted OIBDA.
3.2x, that's manageable, but needs watching.
It's manageable, yeah, but it's a level that definitely requires disciplined cash flow generation, especially for a business this content intensive. Now, they do anticipate a temporary increase up to maybe 3.5x in Q3, mostly due to content payment timing. That happens. But the company expects to exit the year around 3.1x leverage. So it signals a clear, active commitment to delevering. That should be somewhat reassuring, you'd think, to creditors and maybe long-term investors.
That commitment to deleveraging is significant, yeah, especially now with interest rates where they are. But let's zoom out a bit. Any structural tailwinds they're seeing? Yeah. On the financial side, I think there was some legislative news.
Indeed. Yeah, a significant structural tailwind Starz gained comes from the recent passage of what's been colloquially, if maybe a bit colorfully, dubbed the One Big Beautiful Bill Act.
Right.
So this legislation, it's designed to stimulate corporate investment, provide some tax relief in certain sectors. For Starz, it means previously deferred interest deductions are now fully available to them. And this isn't just like a minor accounting change. It's actually going to significantly reduce their anticipated federal tax payments for the foreseeable future. Directly boosts their cash flow.
Ah, okay. So that's an unexpected but very welcome benefit. Strengthens their financial flexibility quite a bit.
A definite plus, yeah.
Okay, so that's a substantial, almost hidden boost. Let's switch gears now to content strategy. Management highlighted a really clear shift towards a franchise-driven model. They said spin-off prequels and sequels typically retain over 85% of the original season's audience.
That's more?
Well, it's significantly higher than the industry average, which is apparently around 50%. What's going on there? Why are they so much better at this?
That 85% retention rate for spinoffs is it's absolutely remarkable, and it's a critical strategic advantage for them. In this super crowded streaming market, right, many services struggle to get new content to stick. New series launches are often a high-risk gamble.
Totally.
Starz, by focusing so intensely on known worlds, known characters within established franchises like Power or Outlander, they drastically reduce that content acquisition risk. And they cultivate this remarkably loyal, predictable audience base. It's not just about leveraging IP in some generic sense. It's really a strategic framework that turns a gamble into a more calculated, potentially high-return investment. It means marketing spend is more effective. Each new show benefits from the built-in audience. For a company so focused on cost discipline, this approach is exceptionally savvy.
That makes perfect sense. Maximize the value of every content dollar. And this strategy really shown, apparently, with Outlander, Blood of My Blood. Generated the third highest number of subscriber ads for a premiere in their history, and a 40% viewership lift over the last Outlander episode.
Yeah, and critically, it drew in both existing fans and new audiences. And impressively, they did this with higher price promotions than they'd used in prior seasons.
Right, that combination, strong engagement, new subs, and higher pricing power, that feels like a really positive signal, doesn't it?
It absolutely is. Outlander, Blood of My Blood, is like a perfect case study for how their franchise model can succeed. Being able to bring in new subscribers while using higher price points indicates, a strong perceived value for the specific content. It's a testament to the brand's loyalty, the quality of the narrative extension they're delivering. This is exactly the kind of performance they need to replicate to hit their growth targets and, frankly, rebuild some investor confidence.
Building on that, the company's also doubling down on cost efficiency. You mentioned that. They're targeting content cost reductions down to $650 million by 2028. Aiming for a 20% EBITDA margin. And their first fully owned and produced series, Fightland, is key here, costing 30% less per episode than previous season 1 premieres. That seems like a tangible improvement in their content economics.
It is tangible, and achieving those broader cost reduction targets, especially getting to a 20% EBITDA margin by 2028, it's ambitious, but it's crucial for them. Fightland serves as this important proof of concept, showing they can produce high-quality, fully owned stuff at a significantly lower cost. This isn't just about, slashing budgets everywhere. It's about shifting their production model, owning more IP, optimizing every stage.
But how challenging is that?
Yeah.
Maintaining quality while cutting costs like that.
That's the challenge, right? Scaling this efficiency across a diverse slate without compromising the creative appeal that attracts their core demos. It requires smart greenlighting, streamlined production, disciplined post-production. A lot has to go right. But the early signs with Fightland are certainly encouraging for them.
Okay, looking ahead then, Starz has an ambitious content slate lined up. They expect sequential revenue and OTT subscriber growth in Q3 and Q4 2025, driven by hits like Force, Raising Kanan, the final season of Outlander, P-Valley Season 3, and a new Power prequel, Origins, launching with a supersized 18-episode premiere.
Wow. Yeah, that's a lot of content aimed right at their core demographics. And the Power Universe in particular is just such a cornerstone of their franchise strategy. Origins with 18 episodes. That's not just a big show, it's like a statement of intent.
Right.
Designed to create a massive viewing event, drive sustained engagement. This slate is clearly built to activate their loyal fan bases, and it's critical for that sequential subscriber growth they're forecasting. If Outlander, Blood of My Blood is any guide, leveraging these known quantities is their best shot.
And they're even bringing back Spartacus after 12 years. I mean, who saw that coming?
I know, right? The return of Spartacus after such a long break is fascinating. And yes, it's a strong signal. Management cited, overwhelming audience desire, significant social media buzz, strong internal research pushing for its return.
So listening to the fans.
Exactly. It shows they're willing to tap into that well of established fan enthusiasm. Proves that a dormant hit can still be a powerful asset if the demand is really there. And the decision to introduce an African-American female gladiator, that's very deliberate, very strategic.
Yeah, tell me about that move.
Well, it's an explicit move to try and merge some of their core demographics, women and underrepresented audiences, into a show that historically had a different, though still passionate following. The strategy is clearly to broaden the show's appeal, align it more closely with Starz' current demographic focus, potentially turn existing IP into a new acquisition driver. It's an astute way to try and cross-pollinate their audience segments.
Interesting. Okay. Beyond content, CEO Jeffrey Hirsch also hinted at exploring M&A opportunities over the next, 12-24 months. He sees Starz as valuable, talking about a phenomenal tech backend or a data stack serving their core demos. And importantly, the relationship with Lionsgate post-split was described as strong, if not better. What do these M&A comments suggest?
Yeah, the M&A comments are very telling. While some might see Starz as, a smaller player in the big streaming wars, Hirsch's focus on their phenomenal tech backend and data stack suggests they believe they have proprietary assets, real insights into their specific, valuable demographics. This isn't just about the shows, it's about the infrastructure to deliver and understand that content's impact.
Blooming.
Exactly. And that strong ongoing relationship with Lionsgate is also crucial. It ensures a continued content pipeline, potentially shared distribution efficiencies. These comments position Starz as maybe a potential target or possibly even an acquirer of smaller synergistic assets, looking to consolidate its niche, leverage its tech advantages in a market that's definitely consolidating. They're signaling they're not just sitting back, but actively evaluating strategic options.
Okay, so management sounds confident, laying out this clear path, but the market's reaction to Q2 was, distinctly negative. Morgan Stanley, for instance, lowered its price target, citing revenue pressures, high leverage like 70% of enterprise value, that's high. And liquidity concerns with a current ratio of 0.18, that's really low, means significantly fewer liquid assets than short-term bills coming due. Plus, a debt-to-capital ratio of 0.79 showing heavy reliance on debt. Metrics that clearly spooked the market, right? The stock gapped down, kept falling.
Absolutely. That market reaction just highlights this profound divergence in sentiment. On one hand, you have management presenting this cautiously optimistic outlook. Cost discipline, strong franchises, clear path to free cash flow. But investors seem to prioritize the immediate bad news, disappointing subscriber trends, the big EPS miss, that elevated leverage. The market seems to be weighing those near-term financial headwinds and liquidity risks much more heavily than the long-term strategic story right now.
It's a classic disconnect. What elements of management's confidence do you find most compelling? And conversely, where do you see the biggest vulnerabilities, the things the market is maybe rightly worried about?
That's a great question. What I find compelling is their unwavering focus on what they can control. Content costs, the balance sheet, leveraging that existing IP, that 85% retention on spinoffs, the Outlander success with higher pricing, it shows they do have a formula that works for their specific audience. The tax benefit from that bill, the Fightland production model, those are tangible steps towards better cash flow and margins.
Okay, so the controllable factors look decent. What about the vulnerabilities?
The biggest vulnerability is precisely what the market reacted to, that struggle to attract new subscribers at scale, especially outside their core niche. Can their cost-cutting and franchise strategy truly offset the need for broader growth in this hyper-competitive streaming world? Or will they eventually just hit a ceiling without expanding their demographic reach more significantly than, say, tweaking Spartacus? That really remains the million-dollar question, doesn't it?
Yeah, it really does. That's where the rubber meets the road, as they say. In this landscape, retention and cost efficiency are absolutely paramount. Starz is focused on specific demos, women, underrepresented audiences, and their distribution-agnostic approach, plus the franchise strategy. It's all meant to carve out a differentiated spot.
But as you said, their ability to actually hit those content cost reduction targets and achieve the free cash flow conversion goals they've stated, that will be absolutely critical in regaining investor confidence over the next few quarters. They've laid out a clear plan. Now it's all about execution, proving their unique strategy can actually deliver sustainable growth and profitability in a really tough environment.
All right, let's shift gears slightly. For our high conviction listeners, here's a, let's call it wild yet plausible idea to consider. Straight from the trading desk thinking. Given Starz' current valuation trading around, what, 4x adjusted OIBDA, and management's pretty aggressive deleveraging and free cash flow targets for 2026. You could look at a highly structured play here. This is not financial advice, obviously.
Right. The core thesis here is basically rooted in a belief that the market is maybe overly focused on these near-term subscriber dips and maybe not fully pricing in the potential long-term margin expansion and the deleveraging story. If management executes on that goal of, say, $200 million in adjusted OIBDA by year-end and hits that 70% free cash flow conversion in 2026, plus gets even modest sequential subscriber growth back on track, well, the stock could re-rate significantly higher.
So how would you structure that kind of speculative play?
Okay, so imagine this. You take a long position in Starz common stock at current levels, but to maybe hedge some of that immediate downside risk, maybe enhance your entry point a bit, you simultaneously sell some out-of-the-money put options, say with a strike price around $10, expiring maybe 9-12 months out.
Okay, so selling puts generates premium income.
Exactly. The premium you collect from selling those puts helps effectively lower your cost basis on the stock you bought. It's basically a bet on management executing that leaner, franchise-driven, cash-focused model and overcoming these near-term headwinds. You're betting the market eventually recognizes what management believes is an undervalued proposition.
And the outcomes.
Well, if the stock does climb, your long position is profitable, and those puts you sold expire worthless. You keep the premium. Even if there's some short-term volatility, maybe the stock stays flat or dips modestly, that put premium offers a small buffer, reduces your loss slightly. Of course, leverage is still a big concern. Any major content miss or significant deviation from their financial targets could be really problematic.
Right.
But that's the inherent risk, isn't it? Chasing this disconnect between management's longer-term vision and the market's current skepticism. Again, just an outrageous but plausible idea. Definitely not advice.
Understood. So wrapping this up then, Starz Entertainment's Q2 2025 results really presented a mixed bag. Some significant financial misses, definite subscriber challenges, but also a very clear, very focused strategic roadmap. Cost discipline, leveraging franchises, charting a path to better free cash flow, and a stronger balance sheet.
Yeah, and while the market reacted negatively to those immediate numbers, management remains, outwardly at least, confident in their ability to pivot towards sustainable profitability and hit those longer-term margin targets. The coming quarters are just going to be absolutely crucial, showing if their strategy can truly reestablish investor confidence and maybe close that valuation gap. It's a high-stakes game of execution from here.
Definitely. This has been our deep dive into Starz Entertainment's latest earnings. Before you go, here's something to think about. In a streaming world that seems obsessed with scale at any cost, could Starz' more disciplined, niche-focused, financially prudent approach actually prove to be the more sustainable, albeit maybe less glamorous, winning strategy in the long run? Certainly something to ponder. Remember, everything we've discussed today is strictly for informational purposes. It is absolutely not financial advice. We'd love to hear your thoughts on Starz' future, though. Hit us up on social media. Thanks for tuning in to The Deep Dive.